Welcome to the deep dive. Today we are cracking open a company that you might think you know, but trust me, you probably don't. We're talking about Post Holdings, Inc., ticker symbol POST.
Right.
When you hear that name, you immediately think cereal aisle, honey bunches of oats, maybe Fruity
Actually, I
Pebbles.
found six.
But relying on just that image means you're missing, well, the entire strategic story here.
That's absolutely right. Our mission today is really to look at Post not as a simple, maybe dusty CPG operator, but as a highly sophisticated, diversified holding company.
Holding company, okay.
Yeah. They've transformed their entire business profile since their spinoff back in 2012. And the sheer audacity of their M&A strategy, well, that's what dictates their valuation and their risk profile.
Okay.
We need to investigate how they execute this high-stakes approach and what the significant risks really are for the long-term investor.
Okay, let's unpack this transformation story then, because the numbers, they're really staggering. Since that 2012 spinoff, they've done over 22 acquisitions.
22. That's quite a pace.
It really is. They completely pivoted from being concentrated just in North American ready-to-eat, or RTE, cereal, which is a pretty mature category,
Very mature,
to this complex conglomerate. And now they're pulling in an impressive $7.92 billion in revenue in fiscal year 2024.
Wow.
That's a compound annual growth rate that, frankly, most traditional CPG companies can only dream of.
Yeah, and what's fascinating here is that the strategic goal, it seems it's always been driving long-term shareholder value through, well, two distinct levers, but they're complementary.
Okay, what are they?
Operational excellence in their existing assets, running things well, and then highly disciplined, opportunistic capital allocation through M&A.
Ah, the deal making.
Exactly. For a company like this, the capital allocation side is where the true competitive moat lies, I think. It's the management's ability to shop for assets, fix them up, and then monetize them. Disparate assets, too.
And that brings us immediately to the central dichotomy. You could say the core investment thesis for Post.
Right.
If you're bullish on Post, you're primarily betting on the C-suite, on management.
You're betting on the jockey, not just the horse.
Precisely. You believe management has a proven track record as astute capital allocators. They reliably generate strong, predictable free cash flow from these often mature businesses they buy, and they consistently redeploy it into value-accretive M&A and, interestingly, highly opportunistic share repurchases.
Yeah, the buybacks are key.
It's really an acquisition-fueled growth story.
On the other hand, though, the bear case is compelling, because the model inherently involves high financial risk and, frankly, a lot of complexity.
Right.
Concerns center on the historically high financial leverage they operate with. I mean, they borrow heavily to go shopping.
Makes sense.
There's also the reality of very modest, maybe even flat organic growth in some of those legacy categories, like cereal and refrigerated sides.
Yeah, the original stuff.
And critically, there is significant execution risk tied to integrating these complex acquisitions, especially, the very large and recent pivot into pet food.
Ah, yes. The big one.
This isn't a passive investment, right? It's a razor's edge strategy that requires, well, pretty flawless execution.
So to understand how they manage this tension, this balance, you have to break the company down into its 4 distinct pillars or operating segments, because they all play a different strategic role.
It's key.
You have the massive post-consumer brands segment, that's the biggest now, housing the legacy North American cereal alongside this new pet food platform.
Right, the old and the very new together.
Then you have the international stabilizing asset, Weetabix.
Ah, yes. Reliable Weetabix.
Provides a reliable base, #1 RTE cereal brand in the UK.
Then there's foodservice. Now that's the high growth but also high volatility segment, focused on value-added products like eggs and potatoes for commercial customers.
Okay, value added, important distinction.
Very.
And finally, the smallest but still important segment, refrigerated retail, known primarily for the Bob Evans brand side dishes.
Mashed potatoes and mac and cheese.
Exactly. We need to look at each one of these segments to truly understand what role they play in fueling this M&A machine.
Agreed.
So we've established the foundation, the cash flow machine. Let's pivot now to the core portfolio. These are the Defensive plays, the cash cows, the segments that spit out the capital needed for those big M&A bets.
Right, and that foundation, it really starts with ready-to-eat cereal. That's where Post originated, their history.
Yep.
It's a massive global breakfast market, valued somewhere between, say, $38 billion and $47 billion.
Yep.
North America is a huge chunk of that.
Huge market.
But here's the strategic reality. The market is mature, very mature. The U.S. market is only forecasted to grow at a compound annual growth rate, a CAGR, of about 2.5%.
2.5%. That essentially means this category is just growing right in line with inflation, maybe barely.
Pretty much.
So what is its strategic role then, if it's not a growth engine?
Well, management is very explicit about this. It is officially managed as a cash cow. Its core job isn't to expand the market size, but to generate highly predictable, dependable cash flow that can then be strategically deployed into those other, perhaps riskier segments.
Right. Feed the beast.
Exactly. And this is reflected in their stated objective, which is purely defensive: hold share and restore margin.
Hold, share, restore margin. Not exactly aggressive growth targets?
No. They aren't trying to steal massive market share from General Mills or Kellanova. They're simply managing their existing assets for maximum efficiency. They hold a solid number 3 position in the U.S. RTE cereal market, roughly 20% branded dollar share. Iconic brands, Honey Bunches of Oats, Pebbles, Grape Nuts.
And internationally, that same defensive posture holds true with Weetabix, right? Number 1 in the UK.
Undisputed number 1. It provides a stable base, insulates them somewhat from, North American market fluctuation.
I have to ask, isn't calling a segment that holds 20% of a huge market a cash cow slightly depressing? I mean, why isn't management fighting harder to eke out real growth rather than just restore margin?
That's a fair question. I think it comes down to return on investment. The historical profitability suggests that the effort, the cost, required to gain, say, an additional 2% market share simply isn't worth the operational expense. Especially when that same capital could be used to acquire a brand in a, say, 7% growth category like pet food.
Okay, opportunity cost.
Exactly. The return on incremental operational investment in cereal is just low. So instead, they're focusing their minimal investment on adaptation.
Adaptation like the health trends. Lower sugar, higher protein, that kind of thing?
Precisely. They are trying to squeeze incremental life out of the category by focusing on innovation aligned with current consumer health trends, developing products lower in sugar, higher in fiber and protein.
Smart.
It's a smart defensive move to prevent, accelerating share loss. But ultimately, this remains a game of operational efficiency and cash flow generation, not really top-line growth.
Got it. Okay, now let's look at the second core segment, refrigerated retail. This is the Bob Evans brand side dishes. Now, despite being in what seems like a very favorable market, the global chilled and deli foods market is projecting a healthy CAGR of 5.7%. This segment has faced significant headwinds.
Yeah, it's interesting. They possess a tremendous competitive advantage here. The Bob Evans brand holds a commanding 50% volume market share in U.S. refrigerated side dishes.
50%. That's huge.
It is. That kind of market leadership, you'd think it translates to easy wins and strong pricing power.
But the performance has been, as management termed it, challenged.
Yeah, challenged is the word. In fiscal 2024, net sales actually declined by 5.6%.
Okay, so what was driving that decline if the market's supposedly growing?
Well, it's 2 key factors that are hitting a lot of CPG companies hard right now. First, distribution losses in some lower margin products. Basically, they dropped SKUs that weren't profitable enough.
Okay, portfolio trimming.
Right. Second, and critically, price elasticities. That's management speak for consumer pushback.
Yeah.
Pushback on the necessary price increases, post-implemented to offset inflation. People are trading down to private label or maybe just buying less volume overall.
So when volumes drop and consumers are pushing back on price increases, what's the strategic response? Is it growth or defense?
It's purely defensive. The underlying strategy here seems to be preserving the value of the brand franchise, maybe for a potential future divestiture, who knows?
Interesting thought.
They are treating it strictly as a mature cash flow asset that absolutely must maintain margin integrity. Their focus is entirely on achieving profitability through margin protection via production efficiencies and cost reductions, rather than chasing top-line growth.
So cut cost, protect the margin.
It's a classic CPG playbook, right? When the environment gets tough, you cut costs and protect the margin at all costs, even if it means sacrificing some short-term volume.
Okay, makes sense. We've established the core portfolio, the engines of stable, predictable cash flow. But cash needs a purpose, right? So let's pivot to where they are actually spending that capital and taking the big swings. The transformative growth engines?
Right. And we start with the food service segment. This is post-catering to commercial and institutional customers. Think restaurants, hotels, hospitals.
B2B.
Exactly. With high-value, labor-saving products, primarily pre-cooked eggs and potato products. And this is key. Post reports that 80% of its egg sales in this segment are value-added.
80% value added. So they aren't just selling simple raw eggs.
No, absolutely not. They're selling labor solutions. Pre-cooked patties, liquid eggs, things that save kitchens time and effort. This makes them pretty indispensable, especially now with major labor shortages affecting the food service industry.
Right. That makes sense. A real pain point they're solving.
And this segment is riding some powerful secular tailwinds. The global processed egg products market is projected to grow robustly, something like a 7.8% CAGR through 2082.
Wow, nearly 8%. That's strong.
It is. That's why Post is committing serious capital expenditure to capture this demand.
Investing back into the business.
Indeed. They are investing heavily in capacity expansion, building out pre-cooked and cage-free egg facilities in places like Norwalk, Iowa, and Bloomfield, Nebraska.
Okay.
They're making a fundamental bet that this market continues its strong growth, and they're ensuring they have the supply chain capacity to meet that demand, specifically for the higher margin value-added products, not just, sheer volume.
But while this segment clearly has high growth potential, you mentioned it also has high volatility, and we saw that pretty dramatically illustrated in the fiscal 2023 results, didn't we?
Oh, yeah. Fiscal 2023 was a textbook case of an external market shock, providing outsized performance. The segment delivered exceptional results.
Well, why?
It was largely due to transitory favorable pricing dynamics resulting from the avian influenza outbreak.
Bird flu.
Right. That constrained market supply significantly, leading to highly inflated egg prices for a period.
Okay, so that's CTG speak for don't model this profit number going forward because it was purely a result of external temporary market dynamics.
Precisely. Post was just uniquely positioned to capitalize when those supply constraints hit. However, when the supply dynamics started to normalize, and management warned they would,
Right, they were upfront about it.
fiscal 2024 segment profit subsequently fell 11.8%. That really shows you the commodity risk they still face, even with the value-added focus. That 2023 spike was essentially a lightning strike for their P&L.
Okay, so does that tell us that investors should just completely ignore those kinds of profit spikes, treat them as anomalies?
Not necessarily ignore them, but understand them. What it also shows, I think, is that beneath the commodity volatility, the underlying value-added strategy is strong. Post actually reported a 7.5% increase in the volume of their highest margin pre-cooked egg products in fiscal 2024.
So the core strategy is working despite the price swing.
Exactly. It confirms that their core focus on labor-saving, value-added products is working long-term, and that does insulate them partially from just the raw commodity price swings.
Got it. Okay, let's turn to the biggest bet on the table. The one that really defines Post's current trajectory, the pet food gambit.
Yeah, this was truly transformative. A huge acquisition that fundamentally altered the company's revenue mix and its risk profile.
And this wasn't a small tuck-in acquisition, was it?
No, not at all.
Mm.
In fiscal 2023, Post made a massive, large-scale entry into the pet food market. They acquired a significant portfolio of brands, including the premium Rachel Ray Nutrish, alongside classics like 9 Lives and Kibbles and Bits.
And then they followed that up relatively quickly with Perfection Pet Foods, too.
Right, adding more scale in manufacturing. This instantly established them as the #3 branded U.S. pet food manufacturer by volume.
Number 3, just like that.
Just like that. We're talking about a company whose foundation was cereal, suddenly becoming a top-tier player in the massive and, let's face it, very attractive pet food category.
The financial impact must have been immediate.
Oh, it was, and substantial. This acquisition was the primary driver of revenue and profit growth for the consolidated post-consumer brand segment in both FY23 and FY24.
So it proved the holding company model can quickly drive size and scale.
Absolutely. Which is essential if you're pursuing that M&A playbook consistently.
But the devil, as they say, is always in the integration. And here is where the execution risk seems the largest. Right?
It really is. Management has been pretty open that the initial integration has been challenging. They've reported underlying volume declines.
Why? What happened?
They specifically cited lost distribution points in Nutrish and experienced price elasticity in Gravy Train.
Okay, lost distribution points. That means retailers actually pulled the product off the shelves.
Often, yeah. or reduced shelf space. It usually points to supply disruptions or maybe poor performance metrics during the handover period. The price elasticity means consumers balked at prices, similar to the Bob Evans situation.
So this is the high-stakes test of the entire M&A playbook then. If they can't fix these operational issues, the whole strategic bet could falter.
That's the risk.
What exactly is the strategy now to turn this around?
The strategy centers squarely on brand revitalization. They're pouring resources into a major relaunch of Nutrish.
Relaunch? What does that entail? More than just new ads.
Oh, yeah. This isn't just a new commercial. It likely entails increased marketing spend, probably a rationalization of stock-keeping units, the SKUs, to focus on the highest margin products, and aggressive distribution recapture efforts with major retailers. They need to prove they can consistently supply these brands and manage their velocity on the shelf.
Analysts, and I think you said management itself, view this integration as the single most important variable for assessing the company's long-term value creation potential. Why the most important variable?
Because it justifies the substantial debt they took on to do the deal. If they fail to stabilize volumes and achieve the expected synergies, it is highly destructive to shareholder value. You'd likely see massive goodwill impairment charges on the balance sheet.
Ouch!
But if they succeed, if they pull this off, they validate the entire multi-billion-dollar strategy. They secure a major platform in a high-growth category, and importantly, they earn the market's trust to execute future large deals.
So the stakes really couldn't be higher on this one.
Not really, no.
Okay, let's pivot now to the financial architecture of this machine, Section 3, the financial engine. This is where we understand how they actually fund these massive bets and manage the associated risks.
We've discussed brand equity, but arguably, Post's most durable competitive advantage isn't really the quality of their cereal or their eggs. It's the management team's proven skill in capital allocation.
The playbook.
That's the playbook. Acquire assets, immediately improve operational efficiency to generate superior cash flow, and then strategically redeploy that cash. The fact that they've done this over 22 times since 2012 suggests it's a repeatable process, not just a fluke.
And that M&A engine is supported by real operational scale, right, which acts as a barrier to entry.
Absolutely. We're talking about a global network of 62 manufacturing and office locations. That's significant infrastructure.
Yeah.
Plus, they have these long-standing integrated relationships with major retailers like Walmart and Kroger and the big national food service distributors. These distribution networks are enormous assets that smaller competitors simply can't replicate overnight.
So let's look at the numbers. If we look at the consolidated financial performance from fiscal 2022 to fiscal 2024, the success of the M&A strategy is pretty visible, isn't it?
It really is. Net sales increased from $5.85 billion in fiscal 22 up to $7.92 billion in fiscal 24.
Big jump.
And maybe more impressively, adjusted EBITDA, which is the key metric for operational profit, grew 46% cumulatively over that two-year period. It reached $1.40 billion in FY24.
46% cumulative growth in adjusted EBITDA. That's strong. Now look at the gross margin, though, from 25.1% in FY22 up to 29.1% in FY24.
Yeah, nearly 400 basis points.
That's not just a small tweak. That tells me they are absolutely dominating the inflationary environment somehow. How are they achieving that much margin expansion when input costs have been rising relentlessly for everyone?
It really speaks to the operational excellence component of their strategy. They successfully implemented strong pricing actions that, for the most part, stuck with consumers.
Okay.
And crucially, they pushed through significant production efficiencies and cost reductions across the board that more than offset that inflation.
Yeah.
They seem to be managing the inputs, the manufacturing, and the pricing strategy exceptionally well across their diversified portfolio.
And that strong margin translates directly into cash generation, which, as you said, is the oxygen for the M&A machine.
It's exactly. Operating cash flow hit $932.4 million in FY24, and they generated approximately $1 billion in free cash flow over the two-year period of FY23 and FY24 combined.
$1 billion in free cash flow over 2 years.
That is tangible, reliable capital available for deployment. It really proves their cash cow strategy is working, generating the funds they need.
But there's always a but with Post, it seems. In their case, that cash flow comes with a massive loan attached, right? Let's talk about the elephant in the room, managing high leverage and debt.
Yeah, you have to talk about the debt. Operating with this level of financial leverage is a material risk. It often worries investors, and frankly, it should.
So how have they managed that vulnerability, especially after taking on all that debt for the large pet food acquisition?
They've been proactive and, so far, pretty successful. They executed a deliberate deleveraging strategy. They reduced their net leverage ratio, that's net debt divided by adjusted EBITDA, from a high of 5.6 times at the start of fiscal 2023.
Which is quite high.
Very high, down to 4.3 times by the end of fiscal 2024.
Okay, 4.3x, still elevated, but a significant reduction.
It is. That reduction, nearly a full turn of leverage in 2 years, provides crucial breathing room. And it shows the cash flow generation is already rapidly paying down debt relative to their earnings.
However, the absolute debt levels remain high. That still makes the company particularly vulnerable to severe economic downturns or sustained interest rate increases, doesn't it?
Absolutely.
I saw a troubling metric cited in the source material. Their Altman Z-score is 1.58. Now, for the learner listening, what exactly is the Altman Z-score, and why is that figure concerning for what seems like a stable CPG company?
Right. The Altman Z-score is it's a multivariate financial formula developed back in the 60s. It measures the likelihood of a company going into bankruptcy or experiencing significant financial distress within the next 2 years.
Okay, a distress predictor.
Yeah. It looks at factors like working capital, retained earnings, earnings before interest and taxes, EBIT, market value of equity versus book value of liabilities,
Right.
things like that. A score above 3 is generally considered safe. A score below 1.8 is considered the distress zone.
And Post sits at 1.58, deep in the distress zone.
Exactly.
Mhm.
Now, for a stable legacy CPG company, a score that deep into the distress zone is, well, it's alarming. It directly reflects the high degree of financial leverage they employ, all that M&A debt. It makes them structurally more fragile than peers who rely purely on organic growth and maintain lower debt levels. This score really serves as the starkest quantitative evidence of the risk inherent in their aggressive capital allocation strategy.
Okay, so that's a key risk metric to watch. But let's look at how they manage the financing side day to day. They're actively managing the maturity of that debt to mitigate some of that risk, right?
Absolutely. That's crucial when you carry this much debt. In fiscal 2024, they demonstrated very proactive liability management. They raised $2.8 billion in new long-term debt. The average yield was about 6.3%, which isn't terrible in the recent environment. And they used that primarily to refinance existing notes.
So pushing the due dates further out.
Exactly. This
Very-
effectively extends their debt maturity ladder, pushes back the dates when those huge amounts of principal come due. This provides significant future flexibility and ensures they aren't immediately vulnerable to short-term spikes in borrowing costs if rates jump again. It buys them time.
Smart financial housekeeping. So with all that cash being generated and the balance sheet being, let's say, aggressively managed, let's look at the 3 pillars of the capital allocation playbook in practice. How are they deploying that cash?
Okay. The first pillar is, no surprise, acquisitions. That remains the primary engine for growth.
Mm-hmm.
And even the smaller deals are strategic. In fiscal 2024, they completed tactical acquisitions of Perfection Pet Foods, which we mentioned, and also Deeside Cereals in the UK. The rationale there wasn't just about buying brands. It was explicitly about acquiring manufacturing capacity to optimize the broader legacy production network. So they are buying factories as much as they are buying market share sometimes.
Interesting. Optimizing the whole system. What's the second pillar?
The second pillar is shareholder returns. Now, since they don't pay a dividend,
Right. No dividend from Post.
they rely exclusively on share repurchases. And they view these entirely as a financial engineering tool to boost earnings per share and manage the impact of M&A.
Financial engineering. Can you give an example?
Yeah, the best illustration of this is what they call the synthetic conversion,
Yeah.
which is it's truly next-level financial engineering.
Yeah.
Quite clever, actually.
Okay. Intrigued.
When they made that huge pet food deal, they initially issued shares as part of the payment, right? Which normally causes equity dilution for existing shareholders. Their slice of the pie gets smaller.
Standard practice.
But Post immediately followed up by repurchasing shares equivalent to those they just issued for the deal.
Wait, so they issued equity, bought a company with it, and then immediately bought back the same amount of stock they just issued?
Essentially, yes. They
Mhm.
frame this as synthetically converting our purchase price to nearly an all-cash transaction.
Hmm.
The strategic goal is crystal clear. By immediately negating the dilution risk associated with the equity issuance, they ensure the M&A benefits shareholders on a per-share basis almost immediately, without carrying that long-term overhang of more shares outstanding.
That is a pure focus on maximizing per share value. Very financially driven.
Extremely. And this strategy continued in FY24. They repurchased 3.0 million shares for about $301 million. And they just announced a new $500 million authorization in August 2025. So this shows buybacks are integral to their strategic financing, not just an afterthought or a way to deploy truly excess cash.
Okay, that's fascinating. Pillar 3? Or is that it?
Well, the third pillar is really debt management, which we've covered. Paying down debt when possible, refinancing proactively. So it's acquisitions, share repurchases, financial engineering, and debt management. Those are the uses of cash. Got it. Okay, moving into our final section, section 4, risk and valuation perspective. Every great strategy, especially one this aggressive, has profound risks attached. And Post Holdings seems defined by its ability, or perhaps the market's perception of its ability, to manage these risks.
Absolutely. And the single most critical risk, the one everyone is watching, remains integration failure, specifically concerning that massive pet food portfolio.
Right. The volume declines, the distribution challenges we talked about.
Exactly. Failure to stabilize that business and achieve the projected synergies would be highly destructive to shareholder value. It would basically be proof that the management team miscalculated the scale or the complexity of their largest deal to date.
Credibility hit. Big time.
Huge. Then you have the inherent danger of the model itself, the high leverage sensitivity, evidenced by that troubling 1.58 Altman Z-score we discussed.
Yeah, that's still sticking in my mind. As it should. Absolute debt levels remain high. That means they are particularly vulnerable if the CPG industry hits a severe, sustained recessionary downturn, which would stress their cash flows significantly. Or if interest rates were to spike again unexpectedly, making future debt refinancing much, much more expensive.
Double whammy potential there.
Definitely a double-edged sword. We also can't ignore the external competitive environment. They are going head-to-head with absolute giants in CPG, General Mills, Kellanova. And they face a persistent, growing threat from lower-priced private label products. This is particularly dangerous in their defensive segments like cereal and those refrigerated side dishes, where consumers are highly price-sensitive and, let's be honest, switching costs are effectively zero.
Yeah, easy to trade down from branded cereal to store brand.
Very easy. And finally, there's customer concentration risk.
Relying too much on a few big buyers.
Exactly. A substantial portion of their revenue is derived from a concentrated group of very large retail customers. Think Walmart, Kroger, and the big food service distributors.
So what's the risk there?
It means that losing even one major contract, say a dispute with a national grocery chain over slotting fees or distribution terms, could have a material and potentially sudden adverse effect on the company's financial stability. They are potentially one bad negotiation away from a significant earnings hiccup.
Lots of risks to juggle.
It's a high-wire act.
Okay, now let's look at how the market is actually pricing all these risks. When we examine valuation metrics, we see immediate mixed signals, don't we? It suggests the market might be applying what some call the conglomerate discount.
That seems likely. The company appears significantly discounted when you compare its enterprise value, or EV, to its adjusted EBITDA. Post is trading at approximately 8.8 times the EBITDA.
8.8x. How does that compare?
Well, it's considerably lower than peers like Kellanova, which is around 14.1x, and General Mills at about 10.8x. That's a massive valuation gap.
Huge gap. Why so big?
That discount, I think it just screams of the market pricing in the high leverage risk, and particularly the integration risks associated with that pet food portfolio. Investors are clearly skeptical about the complexity and the debt load.
Okay, market's cautious.
However, if you flip the coin and look at their free cash flow, the picture is much more attractive. Post's strong cash generation results in an impressive free cash flow yield of around 7.6%.
7.6% yield, that's pretty solid.
It is. That tangible, reliable cash flow generation is a solid counterpoint to the leverage concerns. It offers investors a kind of margin of safety, you could argue.
So the market is struggling then. Struggling to appropriately value this collection of disparate assets. You've got a 50% market share refrigerated side dish business sitting next to a somewhat commodity egg business, next to a premium pet food platform, next to mature cereal.
Right. The high-growth segments like food service, theoretically, should command a much higher multiple than the mature cereal business. But the debt load and the complexity seem to drag the whole enterprise valuation down.
But despite this conglomerate discount, the analyst's consensus price target stands at $131 per share, according to the sources. That suggests that professional analysts, at least, see meaningful upside if Post executes.
Yeah, the sell side seems to believe management can pull it off.
Hmm.
Looking ahead, there are, I think, three crystal clear catalysts that could drive future outperformance and potentially lead to a re-rating of that valuation multiple, maybe closing that gap with their peers.
Okay, catalyst number one.
First, and most obviously, the successful operational and marketing turnaround of the acquired pet food brands, hitting their volume targets, achieving the projected synergies that would validate the massive strategic bet. It would prove the effectiveness of the integration team and instantly justify the company's higher risk profile in the market's eyes.
Makes sense. Prove the big deal works. Catalyst two.
Second, continued high-margin volume growth in that value-added food service segment, proving that this segment's long-term earnings power is durable and can consistently exceed the commodity cycle volatility, showing that that 80% value-added figure is sustainable and drives real profit growth. That's crucial.
Okay, show the egg business is more than just commodity swings. And the third catalyst.
And third, potentially the announcement of another large value-accretive acquisition, perhaps funded maybe by selling off one of the smaller, more mature segments like refrigerated retail eventually.
Keep the M&A train rolling.
Exactly. This would maintain the M&A momentum that really drives the per-share value growth story here and maybe further diversify the portfolio. It demonstrates the playbook is still relevant and potent.
Okay, so wrapping this up, what does this all mean for you, the learner? Post Holdings is, well, it's a compelling and really complex study, isn't it?
Absolutely. It's not just about selling cereal or eggs anymore.
Mm.
It's become this high-octane machine using mature, stable assets, the cash cows like RTE cereal, to fuel aggressive strategic bets, those growth engines like pet food and value-added eggs. And it's all managed via this high-leverage model designed explicitly to maximize M&A returns.
They are managing a highly diversified portfolio with distinct strategic roles for each piece. And the core advantage, as you've argued, is not necessarily what they sell, but how expertly they acquire assets and allocate capital.
And the proof, you could say, is in the pudding, or maybe the portfolio. The 16% compounded annual growth rate of post-share price since 2012. That demonstrates management's extreme effectiveness, historically at least, at capital allocation.
16% CNGR since 2012 is impressive.
It really is. So given that the company's competitive moat seems defined by its playbook for M&A, its financial engineering like that synthetic cash transaction using buybacks, we really must ask the final provocative question.
All right, let's hear it.
Should you evaluate Post Holdings primarily as an operating CPG company based on its brands and its organic growth prospects? Or is it fundamentally something else? Is it really a value-driven, publicly traded private equity firm focused purely on capital allocation efficiency?
CPG operator or public PE?
Which lens gives you the clearer picture of its long-term health, its true risks, and its potential rewards?
Something for you to think about.